All right, let's dive right into this. Welcome to today's Explainer. So we're unpacking one of the absolute most fascinating approaches to stock classification out there right now. If you've ever felt like your investments are just, completely at the mercy of wild, unpredictable market swings, well, you're in the perfect place. We're going to decode the L1, L2, L3 framework. This is a brilliant system used by Bandhan AMC's Chief Investment Officer, Manish Gunwani. And honestly, it's designed to do one crucial thing: balance business quality with cyclical trends, so you're never caught off guard no matter what the market throws at you.
Here's a quick look at our roadmap for today. We'll start with the market regime dilemma. Then we'll decode L1, L2, and L3, move on to the portfolio balancing act, and finally wrap up with how to go about spotting the next winner.
But first, I want to kick things off by asking you a completely impossible question. Can you predict the next market cycle? I mean, unless you've got a magic crystal ball hiding on your desk, you probably can't perfectly forecast the next move by the Fed, the next geopolitical shock, or exactly where interest rates are heading. The hard reality? None of us can. We literally do not know when the macroeconomic regime is going to flip. And that right there, that is the core dilemma of investing.
Which brings us to Section 1, the market regime dilemma.
To really grasp why this unpredictability is such a massive headache for your money, we just have to look at recent history, because different market periods reward completely different types of stocks. Think back to 2017 through 2019. If your portfolio was packed with ultra-high-quality, non-cyclical stocks, you were an absolute star, right? You beat the market hands down. But then, the regime flipped. The COVID bottom hit, and from 2020 through the next 3 years, if you stubbornly held on to only those same high-quality stocks, you completely missed out. The massive market-crushing alpha in that post-COVID era, it came from highly cyclical, economy-linked stocks. So, because the future is just this giant unknown regime, betting everything on one specific type of market environment is, well, it's a total recipe for disaster.
Let's move to Section 2 and see how this builds. Decoding L1, L2, and L3. To survive these unknown regimes, the investment team at Bandhan AMC essentially tosses out the traditional labels. Instead, they use this clinical, three-bucket system based purely on business models and management quality. First up, we've got the L1 stocks. You can really think of these as the all-weather anchors of your portfolio. These are your incredibly high-quality, stable business models. They've got fantastic management teams, and they consistently deliver a high return on equity, or ROE. They aren't heavily dependent on whether the broader economy is booming or busting. They just steadily, relentlessly compound value.
Now, on the exact opposite end of the spectrum, we have the L3 stocks. If L1s are your anchors, L3s are absolutely your wind-driven sails. These are highly cyclical companies. They are massively leveraged to the underlying economy. Sure, they typically operate with a lower baseline ROE, but, and this is a big but, when the economic winds blow in their favor, kind of like what we saw in the post-COVID recovery, these stocks can just surge and deliver explosive returns. And then, sitting right there between the anchors and the sails, we have the L2 stocks. This is your middle ground. These are companies with moderate cyclicality. They don't quite have the pristine, flawless quality of an L1, but they also aren't as violently cyclical as an L3. And most importantly, this is often a transitional space. As we're going to see in a bit, this is exactly where tomorrow's biggest stars are usually born. Now, what's really interesting here is when we look at real-world examples from the Indian market to make this super concrete. On the L1 side, your high-quality anchors are companies like Hindustan Unilever, HDFC Bank, or D-Mart. But over on the L3 side, your cyclical sales are companies like Steel Authority of India, Bank of Baroda, or Ashok Leyland. They just behave in entirely different ways depending on what the broader economy is up to.
All right, Section 3, the Portfolio Balancing Act.
So the absolutely crucial point is this: how do you combine these vastly different elements? It's time to kind of audit your own portfolio structure here. To prevent getting trapped on the wrong side of a market cycle, Bandhan AMC uses a really strict 15% tolerance rule against their benchmark. Let's say a market benchmark naturally sits at roughly 30% L1 and 30% L3. Notice how the fund deliberately caps its maximum exposure to either extreme at 45%. You cap your L1 at 45%, and you cap your L3 at 45%, which leaves a nice float in the middle. By strictly capping both extremes, you are systematically ensuring that you are literally never overexposed to just one market regime.
This actually brings us to a quote that is just central to this entire strategy. Manish Gunwani says, "Don't create alpha by replacing L3 with L1 or L1 with L3. Have both. This is the golden rule of substitution, guys. Survival and true wealth generation require blending both business quality and cyclicality. I mean, think about it. If you dump all your L3s just to buy L1s, you are taking a massive, highly risky macro bet that the economy is about to slow down. If you're wrong, you lose. You really must have both.
Now, of course, there's a strategic cost to playing it this smart. Because you're maintaining that careful balance, you're effectively sacrificing the chance to crush the market by, say, 15% in a short 6-month window. You are willingly giving up those short-term aggressive spikes. But what you gain in return is so much more valuable. You get a highly consistent, reliable 5 to 7% outperformance, or alpha, over the long haul. You stay in the game, compounding your wealth steadily, without the gut-wrenching volatility of just being dead wrong in the macro cycle.
Moving to Section 4, Spotting the Next Winner.
Okay, we've built the regime-proof structure. But how does a top-tier research team actually hunt for those massive multi-baggers within these buckets? It comes down to a mathematical secret: the ratio between the total addressable market, or TAM, and the company's current market cap. Look at it this way. If an industry is growing at 10% and you buy a giant company that already has a 2 lakh crore market cap, your growth is going to be incredibly linear. It just kind of inches along. But if that same industry is growing at 10% and you find a highly competent player with only a 20,000 crore market cap, that company has massive potential to rapidly steal market share. The opportunity size relative to its current price is just enormous.
Historically, this exact formula is what catches those phenomenal winners early on. To find the next Varun Beverages, Motherson Sumi, or Bajaj Finserv, the research team applies 3 really precise filters. Number 1, they analyze that TAM versus market cap ratio we just talked about. 2, they rigorously assess the management's capital allocation discipline, basically asking, can this team actually execute on that giant market? And finally, 3, they hunt for those L2 stocks that have the DNA to upgrade their business models and eventually become those highly valued L1s. Honestly, catching that transition from L2 to L1 is exactly where the biggest money is made.
Which brings us to our final thought for today's explainer. I want you to take a really hard look at your own holdings and ask yourself, is your portfolio built for just one market cycle, or is it built for all of them? Are you relying way too heavily on those L1 anchors, or are you dangerously overexposed to the L3 sales? Applying this clinical framework to your own investments could literally be the difference between getting wiped out by a sudden regime shift or steadily compounding your wealth for decades to come. Thanks so much for joining me as we unpacked this framework. I really hope this leaves you eager to dig deep into your own portfolio.